Hello again. It's time for another Rogers Capital Management Market Commentary, where we attempt to be the antidote to water cooler wisdom. Well, you've made the halfway point of 2022. Congratulations. You've survived. June was another gut punch, down 8% last month. And so that gives us 2022, where we've got January down 5, February down 3, March a little bit of a rally at +3, April was down 8, May you'll remember was flat, and now another June down 8. That leaves us at down 19.74% for the year. And in the middle of last month, we actually hit bear market territory. So officially a bear market. So let's talk a little bit about bear markets. Now, in the modern era, so post World War II, since 1950, we've got 7+ now decades of history to look back at. We've had 10 bear markets, now 11, but let's look back at the 10 previous bear markets. Now, historically, we want to take get a little feel for how long do they last and what's the carnage. Well, the average drop of a bear market since 1950 is -36%. And they have lasted an average of 14 months in duration. Now, that's the average. We've certainly had some worse than that and some that are better than that. Your worst case scenario was a -57%, and that was in 2008, you may remember, financial crisis. Not only was it down 57%, but it lasted 17 months. Now, close behind that was the 2000, the dot-com bubble bursting. That was down 49%, but actually quite a bit longer. That lasted 30 months. Now, the best bear markets, if you can call it that, I guess that would be either a down 22, so just barely a bear market, down 22 in 1966. That was over a very short 7-month time frame. Or some might even say the 2020 bear market, the pandemic plunge. We were down 34%, but it was very short-lived. It was only about a month long before it rebounded and soared to new heights. Now, what differentiates a mild bear market, as we've just looked at, from some of those those more brutal bear markets? One word: recession. Now, recession is defined as 2 consecutive quarters of GDP, negative GDP. If you look that up in Wikipedia or on the internet, you're going to see 2 negative quarters of GDP growth. Now, 4 is a depression, more severe, but a recession, 2 negative quarters. Now, I actually like the National Bureau of Economic Research. They do a little bit deeper dive, a little more technical analysis in defining and calling recessions. And without boring you with all the minutiae and what they go through, if we take a look at their definition of recession and the timings, they actually even do it month by month instead of on quarters. We find some interesting information. In the 4 mild bear markets, that's 1961, 1966, 1987, and then the 2020 bear market, we don't really see a recession present in those. We see that there was a -30% drop on average in those milder bears, and they only lasted, here's the real key, they only lasted 4 months. Now, in the recession-linked bear markets. We see quite a bit more downside, a negative 40 on average, but they last much, much longer, 5 times longer. They average a 20-month duration. Which takes us to the next question, right? What you're thinking right now. Okay, well then, will this be a recession-linked bear market or not? I want to know. Yeah, tell me about it. Time will tell. In fact, this is kind of a weird spot here where you have some things that suggest this shouldn't be a more brutal, recession-linked bear market. The jobs market, retail sales, transportation and shipping, a healthy consumer, healthy corporate balance sheets. Those are several things, 5 things that suggest that this shouldn't be a recession, a real serious downturn. And yet on the other hand, commodity prices, inflation, the Fed's overreaction to trying to get a handle on inflation. The housing market has been strong, but boy, you're seeing that start to change with interest rates going significantly higher. And then consumer confidence at never seen before levels, pessimism, if you will. So are we seeing the signs of a bear market bottom? Well, investor sentiment polls seem to suggest maybe so. Now, this is a contrarian sign. But our investor sentiment, which we've tracked back to 1970, has never before been at this level. We're at 50. The contrarian part of this is that the bottom lies somewhere around the 55-ish level in 2008's bear market, the financial crisis, even the 2000 dot-com bubble, and some of the 87 and the other bear markets, the serious downturns. When that investor sentiment reached the mid-50s, things bottomed out. And we're below even that today. The pessimism is just rampant, not only economically, the consumer, but even investing-wise. Some other signals that we monitor relating to the VIX have not yet triggered, but we've now seen contrarian signals trigger relating to extreme levels of put-call ratios and the velocity of selling. If the percentage of S&P 500 companies above their 200-day moving average breaks decisively above 20%, then that would be another positive sign for stocks that we've kind of found the bottom here and things are starting to turn. Historically, the best time to buy stocks in an environment like this, a recession if we end up there, is 3 to 6 months after the National Bureau of Economic Research, the NBER, announces that we've started a recession. Post-World War II, modern era, recession lasts about 11.1 months on average. And it takes the NBER about 6 months to even declare that it is a recession. And so you can see how, 3 to 6 months after that, typically things have bottomed out. Now, obviously, investors, the markets, will anticipate that. So there's a look at bear markets, some averages. Of course, these are what? Averages, historical average. Okay, this may be an average downturn, recession-linked or not. Could, of course, be worse. Could, of course, be a little better than average. Time will tell. It's going to be an interesting July, that's for sure. We'll talk to you next time.